Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started. Just a reminder for the webinar on Wednesday, December 28th at 11 a.m. New York time. We'll be covering everything in the playbook. There will be a Zoom link placed inside of the course. It will be recorded. The recording will be placed inside of the course as well in the resources library. And you will have full access to that and downloads, PDFs. I know some people had experienced some issues with that, and my apologies. Hopefully that's all been sorted now. And if we have trouble with people getting on, or there's a certain amount of individuals that aren't able to get access for whatever reason on that link, I will do a second webinar also that we can record and place in there just to try and accommodate everybody and answer as many questions. As I mentioned before, well, the first half we'll cover everything in the playbook, the process, the setups, the mindset, just the general daily routine of identifying the best setups. There's some confusion. Few people had great questions, but we'll address all of that. And then the second part of the webinar will be going in dealing with specific questions and answers. And again, that will all be recorded and placed in the resources library. So thank you for your patience. Looking forward to that. It's going to be fantastic. I think it will really glue together a lot of the concepts from the playbook and really hammer home the understanding of, not trying to trade one instrument over and over and over again and looking for a setup every day on an instrument, but looking for the best setups out of a basket of instruments. It might be a first red day setup. It might be an inside day setup. It might be a high of day, low of day setup. For a session scalp, it could be low hanging fruit because they've already moved the market in your session. So there's a lot of things that will piece together, and you'll understand the follow through, the flow, and the continuous rotating cycles of these 3-day movements, and then also understanding the news, how the news plays into this, and then recognizing that even though a market may have a model of a template, it doesn't necessarily mean that that instrument on the day is actually the best trade setup. So that's partly experience. That's going to be screen time. That's going to be, the next level of learning and taking your trading to the next level. But we'll go through some case studies today that are directly from the playbook, and we'll look at a couple of examples and we'll glue this all together. But today we're talking about 4 Keys of Classical Charting Wisdom by Peter Brandt. Now, many of you know that I've talked about Peter over and over again. I've learned just an immense amount of golden nuggets from Peter. He has had a tremendous impact on my trading, unbeknownst to him. I'm sure he knows now. But Peter's a classical chartist, Schabacker, Edwards and McGee, but mostly Schabacker. And that is the original Bible for technical analysis or for classical charting. And Peter's been trading for over 40 years. And one of the most powerful concepts that he talks about is, when patterns complete. And when you understand the geometrical structures, the head and shoulders patterns, the rectangles, the ascending, descending triangles, there are aspects to classical charting. Peter looks at weekly, monthly charts and looks for these larger geometrical structures for possible large moves, range expansions, which we have talked about. Now, some traders have asked me to do a video on using that tool. All it is 100% expansion of the high-low. So if you have a 250 pip box, maybe it's a 500 pip target or a 250 pip target for one full expansion of that high-low. And different geometrical structures are going to measure differently. A rectangle is obviously the high and low, and there are different ways to measure an ascending triangle, a descending triangle, head and shoulders. But the concepts about asymmetrical risk reward, we're talking about a market that for classical charting is when it breaks out and it's going to do a range expansion. So that compressed volume over a longer time frame, when it completes the pattern and they have an entry, Peter talks about 4 key things, and he repeats these over and over again. And this is what I really want to hammer home with the playbook the process and understanding some key components about how I piece together my trading setups based on the understanding of some of the key things that Peter talks about. Number one, charts do not predict prices. So you've heard me say this before. I don't care where a market's headed or where people think it's going. I don't care what it does after I get out. I don't care. I don't care what it's going to do. I only know that I'm looking for setups when I come to the screen in my session. So charts do not predict prices, but the behavior of the chart tells me whether or not I get a trading signal. So for Peter, for classical charting, a breakout bar that completes a pattern is a signal for an entry. And as Peter says in number 2, most chart patterns fail. Now this is a key aspect of how I trade. Right there. Most chart patterns fail. The number one thing that I identify a day one at the high or low of the week heading into a week or a new week is because there's a failed breakout. A failed breakout. The failed breakout is what forms my peak formation on a day one. We'll just enlarge this a bit for people. The failed breakout. Because most chart patterns fail. Al Brooks talks about this. Most breakouts fail. Now we're going to look at some specific examples this week, just this week alone, after the playbook was released, of putting that into action, taking it from theory. Because some traders are saying, "Oh, that one trader, oh, that's great. In hindsight, can we run this through the tester?" But here's the issue that you need to understand. I'm not trying to trade an instrument every day and looking for, I get in here, get in there. It's in a box, but there's 10 instruments that I'm looking at. I want the one that fulfills the criteria of the best setup. So if I'm going to run the Swiss franc through the Forex tester or back tester or whatever that is, that doesn't, number one, I trade the US session. So the trade setup could happen in Asia. It could happen in New York. It could happen in London. But if it's a 3-day setup, and I've repeated this, the best setups come after 3 sessions on day 3, which is Asia, London, New York, for the final move of a 3-day setup. So it's not about going back in hindsight. It's about what did yesterday tell me about today's setups. Is it a day 1? Is it a day 2? Was there a false break? If there's a false break, guess what? And it's a day 3, I may have a setup. That's what is, the first red day, first green day is already potentially reversed a market. The next day could be a retest of the high or the low. We've had a break in structure. It's an inside day. We might be 2 days after a first green day where there might have been news on the calendar. We might have a day 1, day 2, day 3 in the new week for a measured move on that pair, on that one instrument. But there might be a first red day trade on the S&P. So it's about finding the best pairs. You should be able to manage 5 or 6 instruments quite comfortably because it's about what happened yesterday that tells me what I'm looking for today. And in the session that I'm trading in, that's the number one thing that needs to be on my agenda is, has there been any breakouts? Do we already have a failed breakout? Has the market broken out? Do we have news on the calendar? Did I have an actual signal day? Very powerful. But the failed breakout, if most chart patterns fail, that means most breakouts fail. What does that tell you about potential trade setups for reversals? Especially if it's a day 3. Or they failed on day 2, and day 3 is a collapse and a retest, the pump and dump into the open of a session, or the dump and pump. And then there's news, well, maybe the next time is going to be New York Open, or, if you're trading in London or Asia. Very rarely is there news, but Bank of Japan last week. We saw some major, huge shifts. So, number 3, charts simply tell us where a market has been. Key component number 3. If most chart patterns fail and charts simply tell us where a market has been, and they have breakout traders in the market, guess where they might be going? My favorite phrase over and over again is, where is the money? If they break out on one side and other time frame traders are now in the market, longer time frame traders, bigger players, where is their stop losses, their maximum stop losses? Most likely if it's a 1-bar stop, or if it's a daily chart, daily high, daily low. Could be a high of a week to the low of the day. Could be a day 1, day 2, day 3 breakouts, high of the week, first red day, retest and collapse. Could be in London, it might be in New York. It might break down in London and it might give me a low-hanging fruit trade in New York. This is the key. The only value in charts is for trade and risk management. And I've repeated this before in previous videos, that one golden nugget that Peter glued together for me was targeting asymmetrical risk reward. Now, I know that there's a lot of people who use that phrase. I want to get 5 times my risk on a trade. Except that classical charting, if most breakouts fail, and let's say we have a box, well, you know, people have heard me say this as well. Price is always in a box. So if price is always in a box, and it's always trying to break out, and we have breakout that fails, and we have a break in structure, boom. Maybe that's the trade. Maybe that's a 3-day trade. Maybe this is a Friday, that's a Monday, and that's a Tuesday. It could be a day 2, high a day in London trade. That might be a 75 pip box, 3 levels of rise. And I've talked about our strike zones. We're going to go through this in the webinar. That's just one example. We could have, let's go back. We could have a day 1 that breaks out. We could have a day 2 that breaks out, and then we could have an inside day, and a next day breaks down. We have inside bar traders now in the market. They're caught long on the breakout. Their stops are going to be under the inside bar day, but it takes out the low of the week. Maybe it's a Friday might have put in a peak formation high. They've come back up on Monday. Breakout of Monday, and then breaking through the low of the day for a short trade. They reverse at the low of the day on Tuesday, inside bar. They trigger the longs and then go down for a vertical move. Same thing applies in the long direction. I know a lot of traders know that I'm biased to the long side, but the same thing applies. If we have a market that breaks out and it breaks down and starts to trade back up, now we have maybe an inside bar. It might break out as an inside bar and keep going, like we saw in oil. Breakout pullback, day 1, day 2, day 3 for the trend trade. So the variables that you see are not in the process or in the best trade setups manual. It's in your ability to identify and understand the concepts. Once there's a false break, somebody on a longer time frame is in the market, and there'll be other traders on the short time frames trading those last legs down low or up high. And then there'll be traders trying to counter trend a market up here when it in fact is a trending setup. There's no break in structure. Now, my number one goal is to position myself into markets that are going to collapse fast and hard, or peak formation high, peak formation low, consolidation, explode. Day 1, day 2, day 3, consolidation, narrow range day. We could have a market that we say we could big move on a Monday. Could have a big move on a Monday, comes down, we get a day 2 trade, high a day, 50 to 75 pips away from the low of the day. That's our strike zone. Might be 150 even from the high and low of the week. They might go down 175, but they might just come back inside to our 150 strike zone, break in structure, one more stop hunt for the dump, and pump into a session for another explosive trade. So coming back to the 4 keys of classical charting wisdom by Peter, who does not identify whatsoever with short-term trading. But the principles apply because, as I've said, I'm not interested in chasing little moves and swings. That's not my objective, to call a little swing or caught this move, caught that move. I want to trade a setup, and that setup is when either I have a geometrical opportunity for a range expansion in a trend trade. As I've said before, there's three things that markets do. They trend, false break reversals, so they break out and they reverse, or they're just in a trading range. That's it. That's all markets do. And in simple terms, as one trader said, they either go up or they go down. And that's the bottom line. So all the other gobbledygook is what creates analysis paralysis. So if you can't see something simple, this is the number one key aspect about my playbook, is how would I interpret things in live time. It's not about making a decision on about a bar on the day. It's about what setup has built. What setup has built? It could be a session scalp, but it's still a 3-day setup because I still need the bias there. I need 3 levels of rise or fall for a session scalp. But when I get the bigger 3-day setups, whether it's 3 days of breakouts or whether it's a day 1, day 2, day 3, a pump and dump into the high of the week or the low of the week, or dump and pump, or if it's just, a day 1, day 2, an inside bar, day 3 false break, reversal, boom, 75, 100 pips. So you're not going to have, perfect trades every single day, but the chart patterns will set up the opening range, initial balance. Now we have a thesis, trap volume, the false break, high and low of the week, day 1, day 2, day 3, trade. But each day will offer an opportunity perhaps based within that 3-day model as the opening range and the initial balance are built. We might have a day 2 on a Monday. We might have a day 1 on a Monday because it's taken out the high of the week or the low of the week, and it's the 3rd day of breakouts. Breakout traders, short, for a short squeeze, for an explosive short squeeze in the London or New York session. And that forms our initial opening range. Tuesday might be a trend trade in line with that original reversal. So we'll look at some examples from this week. There are already some traders who messaged me right off the bat and said, first trade, paid for the playbook. And, I want to make sure every trader has their best year next year. So number 1, setups for me. Number 2, then developing the skill and the process to interpret that. It's really simple if you step back and understand the whole building of the box. Because remember, this is key. Most chart patterns fail, and I like rectangles. So guess what? If there's a breakout of a rectangle and it's a failed breakout, where's it going? Boom. Hopefully the other side. But hope isn't a strategy. So I've put together some concrete rules that remove the subjectiveness. That's why I put the 5-minute system in there. Now a bit more advanced. Once you understand that process, you understand it's about a level. And you can go to the 1 minute because now you understand where the setup is and the entry, and the 1 minute is fine because it's all about the level when the setup is there. It's not about following the 1 minute chart. Is it going up? Is it going down? I don't know. I'm getting in. I'm going to short it. Boom. I got stopped out. It didn't work. No, it's about having a setup, just like first bounce. I need a setup first before I'm going to take the first bounce. And then I'm going to go to the 1 minute, and I've got my reason, my larger setup for entering that market. I've got a level of strike zone. And I'm going to get in. Boom. And I'm going to be able to manage my risk, execute the trade, and definitely make sure that I get out with profits. So coming back to something I mentioned last week, why would you want to get in and hold on to something for 5 hours and let it go back and forth and swing? I want to get into a setup that's about to collapse or go vertical and position myself with a stop, right? Have it collapse, and I don't care if it keeps going. In some cases I might be holding on if it's a high of the week, low of the week opportunity. But if it's just a high of the day or a high of the week to low of the day and it's possibly going to come back, I want to lock that in. I want to take the money and be done. There's my work day. Time to go. Come back tomorrow. What did I do well? What could I have done better? Did I execute as best possible? Did I use enough size? Was that too much risk on that particular setup, or was that a 5-star first red day, high of the day, high of the week opportunity, like on gold, for traders to crush it and knock it out of the park and be done in 1 hour with whatever, 150, 200 pips. That is a 5-star best trade setup. Let's take a look at the charts. This is the Canadian dollar, and I'm just going to pull up a couple of charts and we'll walk through them because I want to talk about process. That's it. So I really need to hammer this home because there's just there's got to be a shift in understanding. It's not about me coming to the screen and trying to figure out where am I getting in today. What happened on Friday? We had a breakout. We had a breakout on Friday on the Canadian dollar. So when I come to the screen on Monday, there's a breakout. But we've also had a pump day. So we on the playbook, we'll just put this in here. We talk about pump day is the first thing we need for a first red day. We also have day one breakout traders in the market. Now we can go back even further to how that even started. We had breakouts at the low of the week from the week that failed. We had a breakout that failed. We had shorts in the market on other time frames down low. A great question from a trader was, well, why would traders why would they want to trap traders? You need to understand who's getting trapped. The traders that are trapped down here are not the 15-minute, and well, there probably are some 15-minute traders, 5-minute traders, all these other things. These are other time frame traders. Their stops are up here. Their stops are up here. So when this breaks, we've got entries of other time frame traders in the market. They might have moved their positions down now. We might have breakout traders triggered on the next day, but it goes into consolidation. Now the interesting thing is you can measure these, and I'm not going to do that in this video, but we'll talk about 3 levels of drop in the resource library in detail and how to measure those levels. I've mentioned that in some other videos. You have to be on top of your game. And if you just want to master the process, follow one pair and get comfortable with understanding day 1, day 2, day 3. We can go back to the previous week and inside day on the Monday, day 1. We have a market now that has a neckline and pin hammer in our London, just in our London gap between the US session, day 1, day 2 in consolidation. We already have breakout triggers in the market. It makes a lower low. A lower low, peak formation high. We can measure that. We're not going to do that in this video. I don't want to talk everybody's ear off, but we'll talk about the stop hunts, 25 to 50 pips at specific times of the day. Collapse, vertical collapse. There was news on the day, and then they go into consolidation. Day 1, day 2, day 3, sideways, fed, and then we also now have a market that starts reversing inside. Day 1 breakouts on the other side. Day 1, day 2, so we have a pump, a day 2 pump, and then our Monday this week, we have an inside bar. So when we have the inside bar, we have a breakout now that has failed. This breakout right here has failed. How do we know it's failed? Because it's come back inside. If it was a breakout pullback, it would keep going. Number 1. That's our day 1 now. Day 1. I'm going to walk through this and really emphasize the false break for day 1 breakout trades or day 1 trades that failed, because that's the high of the week. High of the week. And now we have our day 1 heading into the new week. It failed. So when I come into the US session, if it's an inside bar and the breakout has failed, it's a day 2, right? It's a high of the day sell opportunity. No news on the calendar. It's a high of the day selling opportunity. No news on the calendar. And lo and behold, we have a first hour low, a second hour high. And we'll measure this. We'll talk about the specific measurements. We talked about this in the playbook. Day 2, measuring on day 2, there's our 3 levels of rise stop hunt into the high of the day for our day 2 short trade. Now here's the other thing I want to say. That doesn't mean that this was the best trade on the day, but this is a specific way to trade this on the day. So out of 10 instruments, was this the best trade? I don't know, but this is how I would trade this on day. It's a Monday, but it's day 2 after the false break. Day 2. Now we have a day 3. This is our first red day. First red day is right out of the playbook, a sell high opportunity. After first red day, it's a high of the day sell opportunity. We get a vertical move in the Asian session that takes out the high of Monday. Our inside bar. Oh, lo and behold, we have a first red day and an inside bar. When they break the high of the inside bar, what happens? We trigger breakout traders. We might hit stops on US session shorts, but we've also triggered breakout traders. They've traded back up into the high of the week. That gets anybody who might have been short, clears out the higher level shorts from Friday, Monday. But we have a first red day. That's the high of the day sell opportunity trade setup that breaks down in Europe, continues to auction lower. So the only option for the US session is to look for the low-hanging fruit. What do I need for the low-hanging fruit? We go and back in the playbook, it says right in there, 25 to 50 pips. Well, let's just measure this just for sake of the low of this bar is 3604.8. So we'll call it 3604 just for fun. 3604, that's 50 pips, but it could be 3 levels of rise. But lo and behold, now if we went to a shorter time frame, this is a 5-minute chart. We have our high bull. We have our second pull candle inside. We have our reverse bear pin hammer. That would be the first entry, the starter. And we know this is 50 pips from high to low in terms of our strike zone level. They've filled the gaps on the shorts from the London session, the Europe session, for a blow-off move of 50 pips. That's our 3-session trade setup on a day 3, and it's a low-hanging fruit short trade. We have a market now that has gone day 1, day 2, day 3. We have a low of the week. When we have a low of the week trade setup, we're looking for the parabolic short squeeze, but it's an inside day. We have a peak formation low, a peak formation high. We draw our consolidation. If you were to do anything on this day, you would count up 75 pips from the low of this day. The low of this bar is 3579. That would take us to 3629. That's 75 pips. That's 3 levels of rise. That's all I would be looking for is a strike zone level between 50 and 75 pips. We'll just clean this up. And that's a potential strike zone in the timing window. And what do I need to do that? I need a pump and dump. Now this market traded inside. It didn't break down and pull back for a long trade, for a potential first green day, whatever that is, or a short squeeze. It worked back up 3 levels before breaking down. Now this is not something I would trade on day 4 because we're down at the low of the week. I'm not looking to short this in down low and get jammed in. I want to be selling high. If I'm going to trade the low-hanging fruit trade, it's got to be on the follow-through on a day 2 or a day 3. And lo and behold, the market breaks structure on the inside. Breaks structure on the inside on the Thursday. Sorry, that was Thursday. Come back, we'll do our count again. Monday, Tuesday, Wednesday. Inside bar on Wednesday. Inside bar. So what happened on Monday? We triggered the breakouts on day 2 at the high of the Monday's inside bar. On the low of the week, we want to break up first, have our break in structure. That begins the dump and pump, the V bottom, and we want to trigger shorts. Trigger shorts, get them in the markets, 3-day breakout. Day 1, day 2, day 3, we had the inside bar on day 2. Well, the inside bar, day 2 from the high of the week. And there's our short squeeze in the London session for the parabolic short squeeze vertically through the high of the day. Now we can talk about measured move targets and all that. But the easiest thing to understand is once they trigger the low, we know there are stops at the high of the day, and they're going to clear out all the lower level shorts. One range expansion of that is a minimum target. And we have peak formation. We have our high bull, major resistance potentially from Tuesday. But that's the simple process. Now, going into Friday, we have a breakout on Thursday. We have a breakout on Thursday. It breaks the high, keeps going, but it breaks down in the Asian session. It breaks down in the Asian session. Go back to Peter's quote. Most breakouts fail. So if I have a failed breakout now, I have a breakout market that's failed. Where is the money? Where is the money? They go all the way down, and then there's news at 8:30 New York time, and they go vertical. When they go vertical in a stop hunt of 25 to 50 pips, let's measure this. The low of this bar is 3574. There's our 50 and 75 pip level strike zones. We'll zoom in on this. We have news. They pump it up and hit the stops into the New York Open. We know where the money is at the low of the week. We already have a failed breakout. They pump it back up into the peak formation and get the lower level shorts. We can go to our smaller time frame, the 5 minute. We have our high of the day structure engulfed. Right near the end of the second hour, we have a high of the session into the peak formation failed breakout. 1 bar stop for a 50 plus pip move back to the low of the day, where we know the breakout traders stop losses are. There is money at the low of the day, the low of the week. And that's it. The process applies when you step back. So we go back to a really simple concept. Just looking at our 15-minute chart. When we start the week, we have a box. We have a box on Friday. They extend the range. But let's, for all simplicity's sake, there's our box on Friday. We have a box where the breakout fails. There's our box. They trade back up into the failed breakout. They trade back up, hit the stops. We've obviously extended the range. Our box is a little bit bigger, but we know that breakout traders are in the market. The new week starts. It's an inside bar. That's the trap. Trigger the stops, hit the stops, trigger breakout traders, and then go back and get the money. Take it lower, day 2, initial balance. There's our new high and low of the week. Once Monday, Tuesday trades, in a large percentage of the cases, your high or your low will be in place for the week. One of those extremes will tend to hold. And in simple terms, this is it. It's a box. Day 1, day 2, day 3. Low of the week. Short squeeze parabolic trade setup. We have a failed breakout for a Friday reversal trade at the high of the day in the New York Open. 2 really great trades. Session scalp. High of the week, short trade, a low-hanging fruit opportunity in the U.S. session. Inside bar trade on Monday. That's it. That's it. That's all I look for. And again, I'm not looking to trade the Canadian dollar every single session, but the process applies across any of the pairs. Best setup out of the ones that I identify on the day. So you can run all this other stuff, but the other criteria is going to be, how well prepared are you? How well prepared are you when you go to the screen? Do you know exactly what you're looking for? Do you have levels? Do you know what day it is? Was there a signal yesterday? What time is it? You know, that's the kind of attention to detail, but it will become second nature because you run through enough of these. You start understanding the day count. You start understanding the bigger picture. These are the trades I want to take. The explosive parabolic moves. The dead, this is a collapse. It's going to go vertical. Why? Because there's money here. They go vertical to get the shorts, and they go vertical back to get the longs from the parabolic short squeeze. You've heard me say this over and over again. Nobody gets a free lunch. And I'm going to be continuing to add to the playbook in the resource library. I really want traders to be able to just nail these trades. So there's there's going to be a skill development phase, because then you recognize the trade and then you start to understand which ones are scalable. We can take a quick look at gold. This is a great example. We had a breakout on Monday, a Friday's high, that gave a session scalp in the U.S. session heading into the close. And then Tuesday, we had a breakout that failed, a short trade that failed. So we had our consolidation breakout, and this is the best part. Guess where they went to? They went to breakout, pullback. We talked about 3 things markets do. They break out, they pull back, and they trend. They break out, they fail, and they reverse. Or they just stay in the trading range. So we have a trading range example here. A couple of days, it finally breaks out higher on Monday. What that means is that the high wasn't in place yet. So they kept going higher. You'll notice there's no break in structure. We're still on the front side of the move. That's the real high. But obviously we've triggered other time frame traders into the market. They continue to go higher. They trade back down into the low-hanging fruit of the breakout. They go into consolidation. They break structure on the inside. When you have a break of structure and it's up, higher high, that's the dump and pump setup. And it happened right heading into our Europe-London Open on day 2. Consolidation. The larger picture now becomes a high and low box. That's a rectangle. That's a high and low rectangle. That's what I love about Peter. His classical charting principles all apply. You're either going to get a breakout that works for a range expansion and a potential measured move, or you're going to have a failed breakout. So we go up. That's our day one breakouts in the market now. Day one, day two. Day two breaks out. Doesn't work. It fails. Failed breakout. But we also have a first red day. First red day is a high of the day sell setup opportunity, meaning that the next day for me to take a first red day trade, I'm looking for a high of the day sell setup. So this is what I mean by what was yesterday. Hindsight pays. Hindsight pays. That's the best part. All these people don't like hindsight. Well, start paying attention to what happened yesterday, because hindsight pays big time. This is a 5-star first red day setup. Now, even better, we have a rectangle again. The best part about classical charting is that when these patterns complete, as Peter says, when a breakout completes, that's the signal. Now, there's a first bar trade on a perfect setup for a breakout trader for a complete follow-through on that trade setup. So this is what happens when you start to step back and allow the market to set up. You know, you'll notice the difference in how some of these, this is a great trend trade on day two, a U.S. session low-hanging fruit trade for the follow-through. We get to Wednesday, we're up high. You know, some traders you're going to get the trend trade on day three because they want you to continue trading with the trend. They want to get you up high or down low. Then we have our high bull major resistance. All the things are in the playbook. All of them. This level now at the high of the week on day two, day one, day two, day three, that potentially may be, because it's a first red day, that high bull major resistance level may be an area that acts as a potential strike zone. That level, that price level, we can measure from the low of the previous day. That level is 118, what we'll call it 119. We add 50 pips to that, and that gives us 169. Let's put 169 on the chart. When we have an existing higher low, though, beyond that level, we redraw our levels. That redraw gives us our strike zone above 50, and this is obviously probably gone 75. So we can move this up another 25 pips. 75 actually takes us right to our high bull major resistance level. The really big key thing about all of this is that there is a process, and I've pretty much eliminated almost every variable out of the equation in terms of being able to come to the screen and form a thesis. It is about hindsight. It's about what happened yesterday. Do I have a signal day? Do I have a first red day? Do I have a first green day? Do I have an inside bar? Have I had a 3-day count? Have I had 3-day breakout trades? Is this a session trade? Has there already been a trade, a reversal or a trend trade, and now in my New York session I'm looking for a low-hanging fruit continuation trade? And if I'm looking for a low-hanging continuation trade, what do? I measure 25 to 50 pips away from the low or the high of the day for the strike zone level. It's all in there, but it takes there's a process to understanding how it just ebbs and flows from one setup into the next. But the bigger the setup, the bigger the opportunity. So instead of trying to focus on catching this little move back and forth, which and I'm not critiquing. There's a lot of people who critique. They don't like my approach, but this is what I'm looking for. I'm looking for that. I'm looking for this move, the low-hanging fruit continuation, the collapse. This is a 5-star setup. Screenshot this, study it, understand day 1, day 2, day 3. First red day, 3 sessions, high of day, sell opportunity for an explosive move. This trade by itself will pay you the whole month what this other little stuff does, if you know when to size in. So next important thing is that traders will take every single trade as the same size. Why would you do that? They'll go large or take the same trade size long as they do this trade short. So it's an understanding that it doesn't matter what instrument we look at. We can find the day one. There's going to be a false break at the higher low of a week. That's our day one count. It might be a day 1, day 2 false break, day 3 inside bar explosion back through our day 1. That's a 3-day setup. So it's a real shift from, catching moves and EMA crossovers and different stuff like that. And it doesn't matter to me how someone trades. I'm telling you what my playbook is, what my best trade setups are, and my rationale behind what I'm looking for and how I can scale that, and how classical charting principles actually apply to all of this more on a fractal level. The consolidation, you've heard me repeat this phrase. Big moves come out of large consolidations. Big moves come out of false breaks. Potential false break, large move. Big moves come out of consolidation. This is a 2-day consolidation. Day 1, day 2, opening range, initial bounce, boom, trend trade. High of the week, low of the week. Inside, peak formation high, peak formation low, consolidation, explosion. Peak formation high, peak formation low, consolidation, explosion. So it's going to be exciting, an exciting year. We're going to go through this and hammer it home and keep refining and getting better. Execute in live time. Have the confidence. Draw your levels. And then understand, just keep building, build to the next level through your accomplishment. Build confidence through accomplishment. That's how you do it. One good trade at a time. One good trade at a time. Build on that and increase size as your results dictate. The setups are all there. They're all there. They're scalable. So it's going to be fantastic. I'm very grateful for everybody's feedback and patience. And my intention, as I've said before, is not only to have traders have their best year ever, but I want to have traders 100 times return on their value on this course. And I really want people to be able to take things to the next level. Have a Merry Christmas, Happy Holidays, however you celebrate it. Stay safe, and may the markets go with you. We'll see you on the 28th.